Let's take a look at the analysis that your Hurst cycles indicator has performed and understand what it all means. The process of performing a Hurst cycles analysis involves identifying what cycles are active in a market at any time and finding the position of the troughs of those cycles and also the peaks of those cycles. The Hurst cycles indicator uses Hurst's diamond notation to mark the positions of the troughs and also the peaks. And so the way that this works is that here at the foot of the chart you can see indicated by a pile of diamonds the position of a trough of a particular cycle, and the positions of the peaks of the cycles are indicated using diamonds up at the top of the chart. Of course, those diamonds are showing us when the troughs or peaks of those cycles occurred. And if we look up from a stack of diamonds at the foot of the chart to price, you can see that those diamonds are indeed marking the positions of troughs in the price movement, and the diamonds at the top of the chart are marking the positions of peaks in the price movement. Now, the cycles are color-coded, and when we take a look at the inputs for your indicator, I will show you how you can change the colors for those cycles. And the way that this works is that because of Hurst's principle of harmonicity and synchronicity, we know that the troughs of cycles occur simultaneously where possible. Your Hurst cycles indicator works with a dual analysis, so it is not only analyzing the position of troughs but also the position of peaks, and it makes the assumption that those peaks are also formed by synchronous cycles. That is why you end up with stacks of diamonds at the foot and at the top of your chart. The taller the stack of diamonds, the longer was the wavelength of the cycle that formed a trough at that particular time. Because of the principle of synchronicity, we know that when a long cycle forms a trough, all the shorter cycles will synchronously form a trough at the same time. And that is evident in these stacks of diamonds. So here, for instance, we have, according to this analysis, the trough of an 18-month cycle. That is that yellow diamond at the top of the stack, and below it are the markers, or the diamonds, for all the shorter cycles, the 40-week, the 20-week, the 80-day, and so on, all the way down to the very shortest cycle. Now, because your Hurst cycles indicator has identified the positions of the troughs and the peaks of the various cycles in the market, it is able to calculate the recent or current wavelength of each one of those cycles. That wavelength for each one of the cycles is presented on the right-hand edge of your chart. It is worth noting that your Hurst cycles indicator performs a dual analysis. A traditional Hurst cycles analysis involves identifying the positions of the troughs of the cycles in the market. Some analysts believe that particular instruments work better, assuming that the peaks are synchronized and they therefore perform a peak analysis. Your Hurst cycles indicator performs both. This is not simply one analysis identifying the positions of troughs and peaks, but it is a dual analysis. It performs an analysis using the troughs in the market, and then it performs a separate analysis using the peaks in the market. That is why for each one of the cycles that you see, you have two wavelengths. The wavelength at the foot of your chart is the wavelength that that cycle is exhibiting in terms of the troughs in the market. At the top of your chart, you see the wavelength that that cycle seems to be exhibiting in terms of the peaks in the market. It is a very powerful approach to combine both the trough analysis and the peak analysis. Now, the diamonds represent the positions of troughs and peaks in the market in the past. In other words, those are positions that the Hurst cycles indicator believes are confirmed for the positions of those troughs and peaks. What is much more interesting as a trader is looking ahead to where the troughs and the peaks of those cycles are going to form next. And that is what these circles with lines through them are all about. We call them the circles and whiskers. You can see that they are in line with the diamonds for each particular cycle. The circles represent the exact time that a trough or peak of that particular cycle is expected to form on the basis of the recent wavelength of that cycle. The lines to each side of those circles represent the range of time that that trough or peak could reasonably be expected to occur. Because of the nature of cycles in the markets being harmonically related and synchronized, you will notice that these circles and whiskers tend to form clusters. Those clusters are called nests of lows or nests of highs. Those nests of lows and nests of highs are very important because they represent high probability turning zones in terms of when you expect the market to turn. I'll be speaking more about those nests of lows and highs in a future video, but let me explain a few more details about the way in which the results of the analysis are presented on the chart. First of all, what we're looking at here is a daily chart, and if I zoom out, you will notice that some of the shorter cycles drop off the display on your chart, because otherwise you get a terrible mess of diamonds. So depending on your zoom scale, you will see information about the different cycles. If we zoom all the way in on the daily chart, then your daily chart will go all the way down to the 5-day cycle. Now let's zoom out again and let's take a look at what's happening at the right hand edge of this chart. Here we can see the whisker for a 20-week cycle peak, which is this green line over here. Now that whisker represents, of course, the range of time in which the peak could realistically occur. If we take a look at a different time frame chart, such as this one, this is a 15-minute chart, you will notice that the 20-week cycle whiskers are no longer visible on this chart. That is because each time frame presents the range of cycles that are of interest, and it avoids clutter on your charts. Of course, on this chart we are seeing a different range of cycles to the cycles that we were seeing on the daily chart. Here we are seeing all the way down to the first intraday cycle, which is about a 5-hour cycle. You might notice something fairly interesting. Here at the foot of the chart is the circle and its accompanying whiskers for the 5-day cycle trough. And over here, you'll notice that a 2-day cycle trough has been found, marking this particular position in the market over here. So why has that been labeled as a 2-day cycle trough when we were expecting a trough of the 5-day cycle, and we still have a circle and whiskers hanging around for the 5-day cycle? The reason for that is because that particular trough in the market is not really very strong, and it's not strong enough for the indicator to guarantee that that is the position for the 5-day cycle. And so what will happen is that you will see the indicator marking the position of shorter cycle troughs, and sometimes leaving the circle and whiskers for the longer cycles because the indicator is not confident that it can place that particular trough or peak in that position. This is very useful because when you're trading a market, the biggest mistake that you can make is assuming that a trough or a peak of a particular cycle has happened and making trading decisions on the basis of the fact that it has happened, only to discover that in fact that trough has not yet occurred. Now there are a few subtleties that I would like to point out. The first point that I would like to make has to do with circles that are not actually on your chart. Let me zoom out a little bit on this chart and I can demonstrate what I mean. When the circle for a particular cycle is on your chart, remember that of course circles indicate the time that a trough or peak is expected to form in the market. When that circle is on your chart, then the Hurst cycles indicator will draw the circle and it will also draw its accompanying whiskers on your chart. You can see examples of that here with the 5-day cycle trough down here at the foot of the chart and the 5-day cycle peak up at the top of the chart. That peak is an interesting one because you can see the indicator has confirmed that that is a peak of at least 1 day magnitude, but it occurred, as you can see, right within the range of time that the 5-day cycle peak was expected. And so it is very possible, maybe even likely, that that is the 5-day cycle peak. Why hasn't the Hurst cycles indicator positioned that 5-day cycle peak over there? Well, because we have recently had some higher price action over here, and so it cannot confidently position that 5-day cycle peak. As time passes, your Hurst cycles indicator will refresh its analysis and it will eventually, of course, position that 5-day cycle peak. But let me get back to the point that I want to make about when a circle is on the chart as opposed to when it is not on the chart. The circle, which indicates the expected time of the next trough or peak of any particular cycle, is often off the right-hand edge of your chart, of course, because it is in the future. However, the whisker, which shows you the range of time that that peak or trough could be expected, might encompass the present time. If the Hurst cycles indicator plotted every single whisker for cycles that are expected to form round about now, then you would end up with a lot of whisker lines right over the most important price action, which is the price action that is happening now. And so the Hurst cycles indicator simplifies things by presenting the lines but not extending them over the current price action. You can see an example of that on this chart. Here is a whisker for the 5-day cycle peak, and you can see it comes up towards the current price action, but it doesn't overlap it. When you see that happening, and sometimes you will see 2 or 3 cycles lined up on top of each other like that, that indicates that that cycle is due now. We are within range of that whisker, but the whisker is not covering current price action so that you can focus on what's actually happening. You can see your price bars. A similar thing happens to the left-hand edge of the chart. It does sometimes occur that a particular cycle peak or trough is very hard to identify. And when a particular circle is off your chart to the left, in other words, it is in the past, then the indicator will do the same thing. It will present a stub of a whisker, if you like, and it doesn't present the full range of the whisker necessarily, because it doesn't want to present too much confusing information covering price action. Let's take a look at a shorter time frame. Here's the 1-minute chart. And if we zoom in, I can demonstrate another point here, which is the power of these circles. When you see a circle on your charts, it is of course indicating the position of an expected trough or peak in the market. Watch those circles carefully, because you will very often find that within only a few bars of a circle, a trough or peak will form in the market. Now, it might not be the actual trough or peak that that circle is warning you to expect, because that peak is expected to form over a range of time as presented by the whisker. And so in this particular case, we're looking at a circle for the white cycle, which is the 5-hour cycle on average, and that 5-hour cycle peak probably occurred over here, if we look back at it with the benefit of hindsight. But very close to that circle, a peak did form. And that is something that you're going to find very useful working with the Hurst cycles indicator. When you see a circle on your chart and you see some evidence that a peak or a trough is forming, you probably want to sit up and pay attention. Let's zoom in on that and see if we can see in even greater detail. If I slide that across a little bit, then we can see here was the position of that circle, and here just a few minutes before that circle formed was a peak in the market.